Are you tired of seeing those red numbers in your investment portfolio, wishing there was some way to turn those losses into a win? What if I told you there's a sophisticated, yet surprisingly accessible, strategy that lets you do just that, potentially saving you a significant amount on your taxes? We're talking about tax loss harvesting, and today, we're diving deep into how you can leverage this powerful technique specifically with Wealthsimple. For many investors, the thought of tax season brings a collective groan. It's often seen as an unavoidable cost of earning. But what if we shifted that perspective? What if we saw tax planning not as a burden, but as an opportunity to optimize your returns? That's where tax loss harvesting shines. It's a strategy that allows you to sell investments at a loss to offset capital gains and, in some cases, even a portion of your regular income, thereby reducing your overall tax bill. Now, before we get too deep into the how-to with Wealthsimple, let's lay down some foundational understanding. What exactly is a capital loss, and why is it beneficial? When you sell an investment for less than you paid for it, that's a capital loss. On the flip side, when you sell an investment for more than you paid for it, that's a capital gain. The Canadian tax system generally taxes capital gains at 50% of their value. This means if you have a $1,000 capital gain, $500 of that is added to your taxable income. This is where tax loss harvesting becomes incredibly valuable. By realizing a capital loss, you can reduce or even eliminate your capital gains for the year. And if your losses exceed your gains, you can even apply those excess losses against other income or carry them back 3 years or forward indefinitely to offset future capital gains. It's a powerful tool, but it's crucial to understand the rules. The most important rule to be aware of is the superficial loss rule. This rule prevents you from claiming a capital loss if you, or an affiliated person, like your spouse or a company you control, repurchase the same investment within 30 calendar days before or after the sale. The CRA is pretty strict on this, and for good reason. They don't want you selling an asset just to claim a loss and then immediately buying it back to maintain your position. This rule is designed to ensure that the sale is a genuine disposition of the investment. Understanding and adhering to this rule is paramount for legitimate tax loss harvesting. So, why are we focusing on Wealthsimple for this discussion? Because Wealthsimple, particularly through its Wealthsimple Invest platform, offers features that can make tax loss harvesting surprisingly straightforward, even for those who are new to it. While they don't explicitly market an automatic tax loss harvesting button in the same way some US-based robo-advisors do, their structure and reporting make it much easier to identify and execute this strategy yourself. Let's break down the practicalities of tax loss harvesting with Wealthsimple. Step 1. Identify your losses, the easy part with Wealthsimple. One of the biggest advantages of using a platform like Wealthsimple Invest is the transparency they offer regarding your portfolio's performance. You can easily see which of your holdings are currently in a loss position. Log into your Wealthsimple account and navigate to your investment portfolio. You'll typically see a breakdown of your holdings, their current value, and your average cost. Any investments showing a negative return are potential candidates for tax loss harvesting. For example, let's say you invested in a particular ETF through your Wealthsimple Invest account. You bought 100 units at $20 each, for a total cost of $2,000. Now, that ETF is trading at $15 per unit, meaning your 100 units are worth $1,500. You're sitting on a $500 unrealized capital loss. This is your target. Step 2. Realize the loss, selling the investment. Once you've identified an investment in a loss position, the next step is to sell it. This is where you convert that unrealized loss into a realized loss. On Wealthsimple, selling an investment is as simple as clicking a few buttons. Select the investment you wish to sell, enter the quantity, and confirm the transaction. Now, here's where the superficial loss rule comes into play again. If you sell an investment to realize a loss, you cannot repurchase the same investment within 30 days. This is crucial. So, if you want to maintain your overall asset allocation and continue to be invested in the market, what are your options? Step 3. Reinvesting strategically, avoiding superficial losses. This is arguably the trickiest part of tax loss harvesting, but it's also where smart financial planning comes in. You have a few main strategies to consider. Invest in a similar but not identical asset. This is the most common approach. Instead of buying back the exact same ETF, you can buy a different ETF that tracks a similar index or asset class. For instance, if you sold a Canadian equity ETF, you could buy a different Canadian equity ETF from a different provider, or one that tracks a slightly different segment of the Canadian market. The key is that it's not identical for CRA purposes, but it still helps you maintain your desired asset allocation. Wealthsimple's pre-built portfolios, which are often composed of various ETFs, can make this easier, as you might be able to swap one for another within your risk profile without fundamentally altering your investment strategy. Wait the 30 days. If you're comfortable being out of the market for a short period, you can simply wait 31 days after selling the investment to buy it back. This eliminates any superficial loss concerns. However, this carries market timing risk, as you could miss out on potential gains during that 30-day window. For most long-term investors, this isn't the preferred strategy. Rebalance into other assets. Perhaps you have other asset classes that are underweight in your portfolio. You could use the proceeds from your sale to buy more of those assets, thereby rebalancing your portfolio while also realizing a loss. This is a particularly efficient strategy if your portfolio is already due for a rebalance. Wealthsimple's diversified ETF portfolios often consist of multiple underlying ETFs. This can be an advantage. If one of the underlying ETFs is in a loss position, you can sell that specific ETF and then replace it with another ETF that offers similar exposure but is not considered identical by the CRA. This allows you to harvest the loss while maintaining your desired portfolio diversification. Step 4. Tracking and reporting. Wealthsimple's role and simplicity. This is where Wealthsimple truly shines in simplifying the process. At the end of the tax year, Wealthsimple provides comprehensive tax documents, including your T5008, Statement of Securities Transactions, and a Capital Gains and Losses Report. These documents meticulously detail all your buy and sell transactions, including the cost basis and the proceeds of disposition. This makes calculating your capital gains and losses significantly easier. You won't have to manually track every transaction or do complex calculations. Wealthsimple does the heavy lifting, providing you with the figures you need to accurately report your tax loss harvesting on your tax return. With that said, thanks for watching, and until next time.